Indeed. Well, thank you for that. I'm not really sure whether I'm supposed to feel optimistic after what's been said or not. But certainly we're looking at a picture now which has quite a very heavy emphasis on political risk. I think that's fair to say. And also this sense of a collective drawing in of breath, not just in the US, but also the UK and Europe, where we look at a rather uncertain political picture. So as you've been hearing, and Frederick was introducing there, we not only have Rebecca and Julien, we also have John Nicholas, who is from Coface, UK and Ireland, and he's a risk underwriting director. So he and Chris Snelson, who's from VF Corporation, and I'll get him to explain what that does, both will be able to talk a little bit more about how it feels on the ground. You've been hearing there about in China what the risks are for corporate debt at the moment. But how does it feel? That is a very good leading indicator as to whether simply there is default risk or not. So, Chris, if I can start with you. If you would just respond maybe a little bit to what's been said, but introduce yourself in terms of what the company does and what you do.
Okay, nobody's ever heard of VF. But we're one of the world's largest apparel companies. So we own the brands, the North Face, Timberland, Lee Jeans, Wrangler Jeans, Eastpak, Napapiri, for those Italian and Spanish among you. And we sell into retail environment across the UK and Europe. And Italy, Spain, Germany and the UK are our biggest markets. So we're selling into that retail environment. And for me, the way we can track what's happening in an economy is very much on what people are spending or not spending. So when customers are starting to have problems in payments and coming to us for payment plans and extensions or there's more disputes, that's when we know something's going to happen in the economy. As we see that sort of bleed out into the country, we usually can predict 3 to 6 months in advance of what's going to happen with that country. At the moment, though, it's all calm. It's quite bizarre. I'm used to having countries where there's something happening, there's some crisis going on. Even the Italians bailed out 2 banks at the weekend in a very dramatic fashion. It was quite odd. So it's very, very weird. So for me, it's unusual to focus on the UK as probably the one area that I'm concerned about, because it's just that's where the more interest is. That's where we see the things happening.
Okay. Chris, we're going to come back to the UK in a second, though. Let's come over to you, John, and say, would you say that you're getting that sense at the moment, that there's a sense of calm, maybe an eerie sense of calm?
I do agree. I share the view that economic conditions seem to be relatively benign. I think that global growth at the moment, as Julien sort of displayed earlier, is still very positive, and I think it's affecting many sectors, and I think one of the slides sort of showed those that are benefiting from this, and there's the likes of pharmaceuticals, automotive, energy. I think at the same time, and sort of focusing a little bit perhaps more on UK with more political uncertainty, there are concerns. There is a sort of a divergence of views in terms of prospects for corporate UK. So if we look at the different sectors, there are others where perhaps there are greater sort of headwinds sort of facing them. I think Rebecca highlighted the fact about the conditions for consumer spending, how that's very likely to be impacted, unsustainable levels of consumer credit, low savings rates, and of course, actual real decline in real income. So a combination of these facts means that I am concerned about the fact that the UK economy, which of course relies quite a lot on domestic consumption, that this is just something to be aware of. Coming to Chris's points about what we're actually seeing, obviously from my point of view, it's really a question of what trends are we seeing in terms of our clients, our policyholders reporting overdues.
Okay.
Sorry.
No, I just wanted to ask you, just very briefly, would you concur with Chris that your lead time in terms of economic conditions, that you are able to act as a leading indicator 3 to 6 months? So if you start seeing turbulence, you know that it might express itself in economic figures 3 to 6 months after that.
Yes, and I think in terms of leading indicators, looking at overdues, we saw this slide about China.
Yeah.
I would pinpoint 1 or 2 areas. In particular, I think in the UK, those companies that are more dependent on imports. We've seen a rise in a number of notifications from overseas clients, so companies importing into the UK, particularly in sectors such as agri-foods. So although at the moment the recovery rates are high, so they're not sort of yet translated into actual insolvencies.
Yes.
But it can be an early warning indicator.
Right. Okay, let's get specific about countries, and I want to start off with the UK, not least because you've highlighted the UK as being one country where there really is quite a bit to watch and quite a bit of uncertainty. Rebecca, it's very difficult to forecast what is going to happen, not necessarily in the next 2 years in the UK, but beyond that. It's a very difficult job, isn't it? I mean, it's largely political factors at play.
I think you're absolutely right. And the problem that we have at the moment is that we actually can't make decisions on some of the things that are most important, like what's going to happen to our labour market, because a lot of that is bound up with the Article 50 discussions, and also what's going to happen to our supply chains, because there is this issue of components coming in and then going out again, and then coming back in again, and then going out again, that's actually going to make our supply chains a lot more expensive. And as you said, with the import dependency that we have, and the low value of sterling, we're also seeing that in the short-term import inflation as well.
Right. So if you are a company having some sort of trade relationship with the EU, would you advise a company at the moment to say, look, something will be worked out? So therefore, it really, in terms of tariffs or whatever, really there is no point in focusing on that. Perhaps more of a worry is the level of sterling. Is that the view that you would take?
So at the moment, I think businesses themselves are saying, and I've run surveys as well, I think businesses themselves are saying, actually, we're going to get on with this.
Yes.
We have to get on with this because, Europe is a growth market at the moment, and developed Europe is a growth market where it wasn't 5 years ago. On the inflation side and on the import side of things, I think that's where maybe some risk management needs to take place because of the impact in the near term on inflation. But these are business costs. These are things that can be properly risk managed. And I think longer term, it's about building strong and steady, if you'll pardon the expression, strong and steady businesses that actually are capable of withstanding some of the volatility that's going to be out there.
Julien, staying with the UK, Rebecca has raised the issue of inflation there. It seems very unlikely that inflation won't start to creep in, oil prices aside. Obviously, we have the weakness of sterling. How do you see that and monetary policy developing in the UK?
I think, what the central bank is really looking at the moment is wages. Because from a central bank standpoint, of course, inflation itself is important. But if you expect this is going to be the higher inflation is only related to what's going on energy prices, most central banks will say, okay, we don't have to do anything because it's going to be temporary. Then what they're looking at is that this second round effects between, on the one side, energy prices and what's going on what we name core inflation. So another way to say that if they start seeing that there are some wage pressures, in that case, I think the central banks will be worried about higher inflation next year and the following ones. At this stage, it seems to me the central bank is fine with what's going on wages, and I wouldn't expect a hike anytime soon in the UK.
Chris, what happens when interest rates start to go up? Does that manifest itself, or there is a threat of interest rates going up? At what point does that manifest itself in the default problem?
For us as a business, a lot of it depends on the brands. Because if you have an aspirational brand, there's always people that have money. Doesn't matter how much inflation goes up, rich people are always rich. So those brands will always be fine. The low-cost brands, that's where we start to see the hit coming in. And that's usually about 8 months down the line.
Down the line from what?
From when we see the inflationary pressures increase through.
I see.
Yeah, so we usually see around about 8 months down the line, they sort of look at inflation, and after a while they sort of think, they're trying to gauge it. Although the people on the streets who are buying this sort of stuff, inflation doesn't matter to them. It's everybody in this room it probably matters to, but it doesn't matter to them, they're still buying. Eventually, when that price goes up and up and up, usually towards the 8-month mark, that's when it starts to bite, that's when they pull back, that's when people don't buy our products, the low-end products, and that's when we see defaults coming through.
Rebecca, you've been fairly clear that you don't think interest rates are going up anytime soon in the UK.
I have been fairly clear. Let me just say, the reason for that is very simply that there's no, as has just been said, there's no pressure from wages at the moment. But there's also a lot of uncertainty, and the inflation is actually coming from the value of sterling. It's coming through imports, and that's not something as such that putting up interest rates will help. So I think there's this discussion going on the Monetary Policy Committee, and apparently a debate between Andy Haldane and Mark Carney. But Andy Haldane was the dove last year that wanted to put down interest rates. Some of us said, actually, that's a silly idea, because as soon as you put interest rates down, you're actually locking yourself into a seriously low interest rate environment that's very difficult to escape from. Now, the argument is that the economists, the experts, were wrong, and that we're actually seeing more growth, and we didn't see the capital outflows, and we didn't see the big sort of mayhem and chaos and Armageddon that we were expecting to see immediately after the referendum. It doesn't mean that the UK economy isn't fragile, and I would argue that although the data is not as good as we'd hope it would be, it's still strong enough to keep interest rates as low as they are because of the political uncertainties. And I think it's these political uncertainties that will keep interest rates on hold.
John, you're nodding there. So if there's an economic imperative to keep interest rates where they are, you would presumably be doubly worried if you saw the Bank of England make a decision that was contrary to that, i.e. put them up.
Yeah, I would be concerned because I think one thing that the UK has lacked over the last sort of few years is investment. I mean, as I say, it's been more consumer-driven, the sort of economy. There's been a lack of investment from corporates in terms of to sort of prosper sort of longer term sort of growth. So I think that could be a disincentive. I think the measures taken yesterday, I think, are a sign perhaps that there is, although relatively minor, I think that probably alleviates some of the risk that they will put up the rates this year. I'll probably share Rebecca's view. Okay. But don't hold me to it.
Let me. Nobody wants to be held to anything at this point. Just to say, there are some microphones out there, so if anybody has any questions that they would like to shout out while we're talking about the UK, before we move on to anything else, I would be delighted if you put up your hand and ask those questions. So you can see two people lurking. So do put your hand up, and I'll come to you as we do that. I'm going to ask from a more European perspective. We've had a lot of debate about hard and soft Brexit. My interpretation of the response, market response, and Rebecca, I'm sure, will be ready to correct me, after the Brexit vote, was very much that the market sort of thought, well, there'll probably be some sort of fudge, it won't be disastrous and so on. But from the European point of view, did the words hard and soft Brexit mean anything, or are these just some sort of political imperative to put a narrative across what is actually a gigantic mess?
No, I mean, even in the rest of Europe, I mean, as you know, a lot of people are talking about that, and this is also the key topic of the debate. But just to I feel, for me, the key point related to this question is that 1 year ago, right after the Brexit, we were wondering exactly the same question. And will it be a soft or a hard Brexit? And 1 year later, in the end, I mean, we're still wondering the same question. And it means that there are still plenty of uncertainties. So now the question is, and this one is very hard to answer, and we go back to Rebecca's point in her presentation, will this political uncertainty have an impact on businesses and on the economy? And on this side, this is really puzzling, because whether we are experts or not, we have a lot of economists have been wrong over the past 18 months. On the US, on the UK, everybody were expecting after this type of risk scenario at political level, there would be a negative impact on confidence and so on GDP growth, and it has not happened so far. So why UK households are saving less even though they're more worried? To me, it's really puzzling, and I can't explain it. So the question is, will it last? Will it last or not? If it lasts, good news for the UK economy. If it doesn't, and if households start to be worried and to save more, then we will see a more significant slowdown.
Broader question to both economists. You'll be aware, I'm sure, everybody in the audience, that after Brexit and around the time prior to that too, there was a rise in popularity in what's called behavioural economics. The feeling was that by looking at hard economic figures, it really didn't necessarily give us a picture of how people were feeling, as you've put it, the mood music. Have you... And of course, the Bank of England, prior to Brexit, Mark Carney was saying that this would not be good, the UK will probably go into recession and so on. And there was it was the first time, really, that there was a very direct attempt to communicate with the population as to how they should vote, right? I mean, normally that isn't really the case. And of course, in the immediate aftermath of the vote, Mark Carney was wrong. The economy seemed to float along quite nicely. And perhaps what was missing in that is what the limitation of economics can do, that you can say there are these imbalances at any one time, but what might trigger a collapse as a result of those imbalances is perhaps harder to tell. So I suppose where I'm getting to, Rebecca, Dr. Rebecca, is, you know, have you changed the nature of your art as a result of this, do you think?
I think that's a really, really interesting question. How long have you got is the answer.
That's why you're answering it and I'm not.
So, I wish we had changed more, because I think the complexities of economics now are such that standard economic models, ever since the financial crisis, don't apply. We're looking at actually monetary policy being not just a domestic phenomenon. As you said, it's an international phenomenon. The Fed does something, does everybody else do something? Does everybody else raise rates at the same time? It has an effect, and it's actually fed through the trade finance system. So because of yields and everything in banks and how finance moves from country A to country B, that means that interest rates aren't defined just nationally anymore, they're defined internationally. And I think what behavioural economics is now telling us is that we need to look at an awful lot of our data, not just from the point of view of the hard data itself, but the patterns and trends that are actually driven by more social things. Now, I have a particular interest in the link between trade and foreign policy, for example. Now, if you start looking at that from a behavioural point of view, you can actually see patterns in trade and patterns in things that are going on in the economy that are actually related to national security and national interest and actually what we might call security strategy. And that begins to tell you that actually there's some behaviour stuff going on at a political level in the trade data. In the end, companies like Google collect vast amounts of data, and this is kind of my final pitch on the economic theory side of things, but companies like Google collect vast amounts of data, Amazon and so on, and actually Equant has vast amounts of data as well. We drive our models on the basis of the maths and the patterns in it, not on the basis of assumptions. And I think what's really changed in the last few years is that we can't make assumptions anymore about what's going to happen.
Mm. John, would you say that the picture has changed a lot in terms of how you, how you see what's happening on the ground, or are you still saying, okay, I can look at the hard data and rely on that?
I think we would look at different sources
Yes,
in terms of sort of give us a guide. Obviously we react to our own experiences in terms of Coface experiences and those in the wider market as well. I think that's obviously a key thing, using our proprietary information for that. No, I mean, I think it's just being aware of the different opinions out there, and as I said, our own data, which will drive and determine our underwriting strategy.
Julien, same question to you. Do you feel it a nature to change the art of economics?
Yes, I mean, it's a bit of a paradox because we have